Morning. It's 10:17. Now we're going to start. Thank you for joining in. I know people are still logging in. I see about 75 people have logged in. This has been one of the most popular topic, looks like, in our webinar as people are joining in. I'm going to share a screen in a minute. Good morning. This is Sumant Timsina from Washington, D.C., from International Development Institute. We have our presenter for today, Mr. Michael Edwards. We're going to go over the topic in a minute. And this topic has been pretty popular at this time with COVID-19. But before we start, I just wanted to make sure that you are all staying safe, following all the guidelines of whichever country you are from. And there are about 9 countries have logged in for today, from Nepal, India, Pakistan, Myanmar, Nigeria, Senegal, Gambia, and I believe one from Egypt also, and of course USA. So today's topic is the regulatory and supervisory responses to COVID-19 by financial regulations. And we have been doing this, we have been doing a number of webinars lately, and this is the first one as a series for financial institutions. We have done for education. We did a couple of them for the soft skills, and we have also done in tourism, public-private partnership. So the financial institutions, we're going to have series of workshop or trainings or webinar, whatever you call it. After today's, we have one, there are 2 more by Michael, one on cybersecurity and one on AML CFT. And that's coming up very soon. And I know that lots of people have signed up, and hope you can go back and sign up for those classes as well. And I guess he doesn't like it. And then we're going to also come up with some fintech topics. We about to announce a date very soon. And we have accessible tourism lined up, as well as public procurement. Public procurement, we did one on tourism, and other one is coming up in hospitality. In healthcare management. And if you have if your company is the one who invests in healthcare, et cetera, I will encourage you to join on that one as well. And the presenter will be Mr. David Baxter. And we're also going to have one for public procurement, general public procurement. We're working out with our faculty just to come up with a suitable date. And there'll be a number of soft skills lined up. And I encourage you to visit our website, our social media, and see what fits you, what works best for you, and then sign up. And this is our email address and website, and we are on social media. And those who have signed up, you may be getting email from our office with our schedule. And just encourage your colleagues, they are all free at this point. And having said that, I'm just going to introduce Michael first, and then I'm going to talk about a little bit about topic, and then I'll hand it over to Michael. So Michael is an attorney at law. I'm not going to read this bio we put in our Facebook and as well as in our website. And Michael is an attorney at law, and he has lots of experience he brings from credit union and banking institutions. He has been our faculty at IDI. So those several people from financial institutions who have come to our regular training in US, they have met Michael, whether they were from cooperatives, credit unions, or commercial banks. And Michael has a JD from American University and also Masters in International Affairs from American University, plus he has a bachelor's from University of Pennsylvania. So before I hand it over to Michael, I just want to talk about, this topic is really, really important. It has put lots of pressure on small businesses, large businesses, financial institutions, and especially taking different measures of encouraging banks to work with the consumers, while the banks are totally closed and they have to make lots of adjustment to banking regulations. And it's not that easy to make adjustment to banking regulations as well as do business as usual. And so Michael and I talked about it. So we're going to cover some from the global perspective, what's going on in different countries. And some of the countries we have covered that you represent, some you may not have covered, but it gives a pretty good background on best practices, let's say. So, and then at the end, I will encourage all of you to use your chat window or Q&A to send us your question and answer. And after that, we will we'll take that question and answer, and we'll give it out to Michael, and he can answer those questions towards the end of this. And he will go for about 30 to 35 minutes. And last 10 to 15 minutes, we will entertain the questions. So Michael, it's all yours, and here you are.
Great. Well, thank you.
Yep, you're good, Michael.
Okay, great. Well, thank you very much, Suman, and hello to everyone who's on the webinar today. As Suman, introduced me, I'm Michael Edwards. I'm a lawyer. I'm based in the Washington, D.C. area, and I used to be the General Counsel and Senior Vice President for Advocacy for the World Council of Credit Unions, and I worked for the Credit Union National Association in the United States as well. But with World Council, we represent credit unions, but also cooperative banks, mutual banks, other banking institutions. And I did a lot of work with the Basel Committee, the Financial Stability Board, and other international standard setting bodies. So today we're going to first talk about what the international organizations are doing, and then have country level examples of how that is being phased in major economies, and then a sampling of other ones based on some degree on the attendance who is. So I'm going to start my my slides here, just a second. And all right, so
you said to share the screen.
Yes. All right. Here we go. All right. So we've already done this slide. This is my contact information. And so, all right, so everyone is well aware of what's going on with the COVID-19 pandemic. This is, basically an unprecedented event, or at least in the past 100 years, where essentially the global economy has suddenly come to a halt. And that's having an effect on all sorts of businesses and also individual consumers. And so that's creating secondary effect on the banking industry, because people are unable to pay loans. And that is also leading to with people to withdraw deposits in many cases because they need the money. But in some places like Russia, they had over $10 billion US withdrawn from banks because depositors are concerned that the banks may fail. And they don't really have deposit insurance. That's probably happening in other countries as well. And businesses taking large deposits because they have no cash flow, so they're using that. Also, banks that have securitized loans, either in asset-backed securities or covered bonds, are generally continuing to make payments on those asset-backed securities. So the investors continue to receive the payments for that, which are mostly other financial institutions, pension funds. Ultimately, in many cases, widows and orphans will be the ones who benefit from that. And that's helping prevent there being a larger contagion in the financial system, because if bonds started going bad, then you would have even bigger problems. However, that all of these things together, the lack of cash flow because loan payments are not coming in, the withdrawals of deposits, and then continuing to have to make payments to other financial sector intermediaries, whether are asset-backed securities or anything else, is being a real liquidity challenge for most banking institutions right now. It's a triple whammy essentially. Plus you have the market volatility going on, and basically there's been major changes in the pricing of assets as banks are trying to sell investments to get cash, and people are not necessarily sure how much an asset-backed security might be worth down the road. So that is causing problems in the trading book essentially, although how exactly that's affecting institutions is kind of too early to say, but if you're running a bank, you probably are aware of what it's doing to you. Now, of course, you could move those assets to banking book, normally under accounting rules, even if they're changed in the banking book, or even if they're changed in the trading book, if you hold them to maturity in the banking book, you might be able to reverse all those losses related to the trading book. Now, so this is, as it is right now, essentially a liquidity crisis. The larger question, though, is that ultimately going to become a credit crisis? Really, the question is, and in financial regulator language, this is the risk of adverse macro financial feedback loops. But in reality, what that means is if people aren't working, the economy's shut down, they don't have the money to pay their loans, and those loans are having an effect on the banking system, right now liquidity. But ultimately, if people are not able to pay those loans, and if firms go bankrupt, particularly ones that are highly leveraged, that's going to cause real losses in the banking sector. And so this may mushroom into a credit crisis because, how many businesses have enough cash set aside to cover months of so it's still relatively early. We're not sure exactly how this is going to play out. It may turn out that the pandemic is less bad than forecast, or it might go on for years. So, but let's look at what the IMF has said. This is from the International Monetary Fund's most recent Global Financial Stability Report. Basically saying most of the things I just said about risk asset prices and global financial conditions, but also, emerging markets are having a lot of money taken out of them, foreign direct investment, basically the investors need their money and they're taking it out. So that is a problem in many countries, that you have a outflow of financing. And then, essentially if financial conditions get worse, like I said a minute ago, you're going to potentially have a cascade effect where you have businesses that can't pay their loans and go bankrupt, banks that are overexposed to particular industries. Oil, which has been lending to oil companies, has been an area of concern at the international level and regulators for several years, ever since oil prices declined a few years ago. Oil exposed economies, they're not only do you have problems with the economy, your currency decreases in value, and there's just all these different knock-on effects. And so, the general feeling is that banks are better capitalized and more prepared than they were in, say, 2007, 2008. And the new Basel III framework has been phased in most jurisdictions, or is in the process of being phased in. And that Basel III significantly increased capital requirements over Basel II, and also has liquidity measures that, because the last crisis was essentially a liquidity crisis and credit crisis as well. But Basel II did not have the liquidity measures. So hopefully these things will turn out to be worth what they were advertised for. But again, it's not fully phased in, and we'll have to see. So also the IMF has said, there needs to be international cooperation, and that's also what other regulators, including the Financial Stability Board, based at the Bank for International Settlements in Switzerland, along with the Basel Committee and several other international so the Financial Stability Board has, put out 5 principles for bank supervisors. The first is that the Financial Stability Board is coordinating the international response. And this is what the Financial Stability Board is supposed to do. It was created after the last financial crisis as a mechanism specifically to address macroeconomic financial stability issues. And you know, of the different organizations like the Basel Committee, the Financial Stability Board, I would say the Financial Stability Board tends to be considered the most prestigious. Although the Basel Committee is the one that actually is putting out standards that you know, are being in most cases. It makes sense that the Financial Stability Board entity here. They're also sharing information. They've said that the existing things in international standards where there is flexibility should be used. So in particular, there are two capital buffers in the Basel III standard. The countercyclical capital buffer, where firms add 1 or 2% to their common equity tier 1 capital, the most desirable kind of capital under Basel III, retained earnings, and common stock, or proceeds from common stock. And in some cases that's been phased in. Some countries like, and I'll talk about this later, in the United Kingdom, they have released this buffer. There's also a capital conservation buffer, which is more firm specific. And so essentially the regulators have been, the national level regulators have given the green light to use those buffers. The liquidity buffers, essentially, well, this is a little less publicized. You know, firms are essentially allowed to use the liquidity that's required. In some jurisdictions, they are changing the rules. In other ones, use the liquidity temporarily. You can go through the buffers. And, you know, to be honest, if you can't use the liquidity, you cannot, it's not liquidity. I mean, if you, whatever high quality liquid, you can't use it, it's not liquidity. So, then also essentially temporarily reducing operational burdens, basically delaying new rules and relaxing technical standards. And then, but they want all of the regulators to maintain the international standards and not go backwards and say, look, we're just going to drop this Basel III thing. That's not allowed. You're supposed to work in what they have said you can do. And then the Financial Stability Board is going to tell everyone when they can go back to normal. So now that's all the high level kind of what are we trying to do. The Basel Committee on Banking Supervision, which is based in the same building, has put out a standard on measures to reflect the impact of COVID-19. And this is the document, came out earlier this month. That is the main issue, that if your jurisdiction has not taken COVID-19 measures, or there are measures we're talking about here that have not been utilized in your jurisdiction, this would be the standard to use as a talking point with your regulator. Basically, this issuance deals primarily with regulatory capital treatment and also loan treatment, which is going to be on the next slide. The risk-based capital treatment. So basically, if you have a loan that is guaranteed by a sovereign government, then the risk weighting of that loan is going to be the sovereign. So many jurisdictions are issuing guarantees of different loans, and so then the risk weighting would be the weighting of the sovereigns. So in the United States, for example, the federal government in the United States has a AA credit rating, and they are risk weighted at 0%. So investments in U.S. government guaranteed things are weighted at 0%. It doesn't require any capital. So that is whatever your jurisdiction's credit rating is and your risk base, whether it's 0% or 20% of risk weight. In any case, it's going to be relatively well. Basel Committee and the International Financial Reporting Standard 9, IFRS 9, issued by the International Accounting Standards Board, put a 90-day past due definition of default or non-performing assets. Now, with IFRS 9, that's a rebuttable presumption. The Basel Committee standard is a little bit tougher because they don't want banks to have loans that have never had a payment in years and they're held at full value. But in the case of a loan where the payments have been rescheduled because of COVID-19, essentially that 90-day past due definition is not applicable. And basically, if there's a payment moratorium, whether it's public or granted by a bank voluntarily, that should not lead to the loan being categorized as forborne and treated a problem asset. Now, the Basel standard goes into detail on IFRS 9 in particular. So in IFRS 9, it uses what's called a three-bucket approach. Basically, loans, when they're originated, are put into the first bucket, bucket one, where you do not recognize lifetime expected credit loss. But if the loan has problems, people don't pay it for 30 days, or you have other information about the borrower, you move into another bucket, either two, which is for things that are sort of problematic, or bucket three, which is for things that have serious problems, or your large exposures that are problematic, where you recognize lifetime expected losses. So the Basel Committee has said regulators can say, look, payment moratoriums do not mean that you move it from bucket one to bucket two, bucket three. And they said you should use expert judgment, which is, I think, essentially supposed to mean that you're getting some leeway there with your accounting professionals to say, we think this is okay. We don't think we need to necessarily increase our loan loss reserves. And basically, you should estimate things based on the mitigating effects of COVID-19, whether that is of the relief measures, whether that is based on just loan guarantees or the economic interventions that countries are making governments to pump money in the larger economies where they can afford to do that. They certainly do that. Other countries are trying to do it too. So you could essentially say, look, we don't think we need to increase our reserves because there are all these government interventions in the economy. They're giving people money. Whatever the circumstances are in your jurisdiction, you can essentially look at that. Now, this transitional measure phase in for IFRS 9 in the next bullet is actually potentially very important here. So several years ago, the Basel Committee approved a standard that allows supervisors, national supervisors, to allow banks to phase in the difference between the reserves under IFRS 9 and the old incurred loss methodology, IAS 39, and essentially add back the additional reserves required by IFRS 9, basically on day one. That's the way it was supposed to be, is that the day we phase in IFRS 9, our reserves go up. We can add that addition to reserves back to our capital as a regulatory capital item that then gets amortized over 3 to 5 years. And so the Basel Committee said, you can use this even if you didn't use it previously. And you can essentially do it differently than you can have 5 years where you have it at 100% for the first 2 years, 2020 and 21, and then do a 3-year straight line phase out where you're essentially amortizing it. So how it originally would have been is 100% in the first year, then 80% the second year, then 60%, and you amortize it that way. But now they're saying that supervisors can do a 100% add back in the first 2 years, and then the straight line amortization phase out is going to be just for 3 years. So that essentially means IFRS 9, if your jurisdiction implements this, will not have any impact. And the United States uses, at least for a couple of years, the United States uses a similar current expected credit losses standard it's under US GAAP, but they've essentially, they are going to use the 3-year phase out, and they've delayed essentially the use of their expected credit loss methodology as well. And the other thing with this transitional measure is the way it's supposed to work is it's simply the day one increase, which is the original way. They've now said that you can change that, so you can keep a running tally. Okay, our losses under IAS 39 would have been X, and our losses under IFRS 9 are Y. And rather than it being just the increase on the first day of IFRS 9, you instead just keep a running tally of what's the difference. Use that as your transitional measure capital add back. So I'm hoping that regulators around the world will take this up if they haven't already. There was some resistance to it initially because some of the larger jurisdictions decided they weren't going to do it, and then smaller jurisdictions were concerned that they shouldn't do it either because the big ones were not doing it. But I think that it's going to catch on, and this is something I lobbied for back when I worked for World Council Credit Union, so I'm glad it's there. All right, so that's what we've gotten from the international global level. And so the European Union is also an international organization, you know, for Europe, or many European jurisdictions. And so they have put out a bunch of different standards that essentially do what the Basel Committee says you can do. And they are putting out new ones. They put out 2 yesterday that are not on this slide because they weren't out when I did it. They put out a technical standard on basically assessing problem loans. They've said for supervisory reporting that you can have a delay of at least a month on both reporting to the supervisor and the what are called Pillar 3 disclosures. These are your quarterly reports that you give to the market for market discipline, essentially. So it's nice to have some delay there. The guidance on loan payment moratoria also says essentially if you have a moratorium, it's not treated as past due. And they've issued a statement on IFRS 9 and COVID-19, which quotes from the Basel Committee. I mean, well, it doesn't actually quote from it. They just seem to have copied and pasted most of it, changed. So that's good, essentially, especially since in the European Union, many of the actions have to be approved at the European level, the national level regulators can't do it based on what the Basel Committee said necessarily. They've also are postponing stress tests, and again, they told the national level supervisors they should make full use of flexibility in regulations, like releasing capital buffers. Now, other EU measures going on, these are more interventions in the economy. So state aid in the EU is not allowed unless it's approved by the European Commission. So if you're in Europe, importantly, the Commission has approved COVID-19 related state aid to banks, and they did it very quickly. Usually they approve this stuff, it takes longer, but the European Central Bank is providing emergency liquidity to euro-denominated financial markets. And also the European Central Bank directly supervises the systemically important banks in Europe. And the European Central Bank has told them that they can release their countercyclical capital buffer. Presumably the national level regulators have been telling their smaller banks that as well. Now, they've also had the central bank, the European Central Bank has an emergency pandemic purchase program where they're buying securities. The public sector securities banks are selling to raise cash, liquidity, and also private sector securities. And, under the Basel III liquidity measures, the liquidity coverage ratio and the net stable funding ratio, short term and the medium term 1 year liquidity measures, respectively, those essentially assume that things like private sector securities are not going to be as saleable in an emergency. So the fact that the European Central Bank is buying them presumably for full face value is a good thing, and means there's more liquidity than what the Basel III standard would have assumed in this situation. There's also been financing to small and medium enterprises from the EU level to supplement what the member states are doing, and there's lots of different, there are 20 plus member states in the EU. They all have their own initiatives, which vary somewhat. Sweden is doing something very differently from what France and Italy are doing, but they're all doing something. Now, moving to what the Bank of England is doing in the United Kingdom, so the UK, major economy, recently left the EU, and so they can they're a member of the Basel Committee, financial stability, do what they want now. They don't have to get approval from Brussels. And the Bank of England and the Prudential Regulation Authority are, well, the main entities here. There's also the Bank of Scotland, which is the central bank for Scotland, and Northern Ireland doesn't have a central bank. They're issuing their own banknotes. Basically the Bank of England is one for England, basically the UK, and the Prudential Regulation Authority supervises banking institutions and credit unions throughout the entire United Kingdom. So they reduced their rates to 1/10 of 1%. The term funding scheme, which is basically lending to banks at this low rate, provided the banks loan to businesses at that preferential rate or a rate just above it. And that's a up to 4-year loans. They're also purchasing corporate debt. They released the countercyclical capital buffer, and they basically told banks that they have significant time to restore capital buffer. The Prudential Regulation Authority, the PRA, has issued a statement on IFRS 9 and COVID-19. It's a little bit different from the Basel Committee standard, but only in the technical part, saying mostly that it's too early to forecast reliably, so you shouldn't. Other than that, it's consistent with the Basel Committee guidance, but unlike the European Banking Authority, it was not at that pace. They've also canceled stress tests for this year. They basically are encouraging banks to stop doing dividends by buybacks and bonuses. They've also delayed some initiatives and regulatory reporting for a month or two to essentially give firms time to get their houses in order with this new situation and see how things transpire. Now, the United States, where I'm based, so they have a paycheck protection program. Basically, these are loans that are guaranteed by the federal government Small Business Administration, intended for small businesses. Some larger businesses have got it. There was originally a tranche of $349 billion, which has been exhausted. There's more money that is probably going to be approved by U.S. Congress today, which I've included in the $660 billion figure. And essentially the way these loans work is that if they provide 8 weeks of funding for payroll expenses like salaries and benefits, plus utilities and rent, and if the borrower uses the funds for those purposes, certifies them, then they do not have to pay the loan back. So these loans have been given a 0% risk weight. The way that they have a low interest rate, but banks are getting origination fees of up to 5% to make them. The U.S. government basically is using the banking sector to put out what amount to grants because that's the fastest way to get the money out the door and into people's hands. So there's been huge demand for that, and that's really the main thing that the United States is doing. There's other initiatives too, but they're focused on, say, the healthcare sector. It's a lot of money, and the United States can afford to do it, like the UK can afford to do this stuff. Now, not all countries can afford to do that sort of stuff, and we'll be talking about some smaller economies in a minute. Now they're providing emergency liquidity through several different types of funds. The Federal Reserve banks are making liquidity available to their member banks. There's another type of government-sponsored liquidity providing bank called a Federal Home Loan Bank, which is supposed to do housing finance, but their money can be used for other things. The credit union sector has a government-sponsored liquidity fund that borrows from the U.S. Treasury that the credit union regulator, the National Credit Union Administration, trying to borrow as much as possible from the U.S. Treasury and then lend to primarily the medium-sized credit unions, the ones below $1 billion in assets, largely, but any of them, but the smaller institutions in particular. And you know, normally you cannot use emergency liquidity to increase your balance sheet, but they've said you can do that. You can expand lending, so it's emergency liquidity, but not. It's really, you can use it for loans, which is different than usual. They've also issued guidance on loan forbearance and modifications, and basically saying that they're not troubled debt restructurings, forbearance. I mentioned the U.S. GAAP expected credit loss standard. They are essentially ending that temporarily. It had only been phased in for publicly traded banks, and now it's and then for mortgages that are government sponsored, essentially, which many of them are, there's a foreclosure and loan payment moratorium on those up to 180 days. When a bank has a low capital level, they have to file a capital restoration plan with their regulator. Essentially, that's streamlined where you approve a pro forma type plan. And then other things operationally, so appraisals of real estate are temporarily suspended. And you can do, you're required, there's strict rules on appraisals, but they've been loosened. Essentially, a bank can do a desktop appraisal of the collateral, the house collateral, rather than hiring someone to go out to location. And you don't even necessarily need to do the appraisal for several months. And then the examinations by the regulators are largely being done off-site, rather than coming to the bank's offices and going through papers. They're using secure portals for banks and credit unions to submit documents to them over the internet. They already had this system in place, fortunately, but essentially all encrypted, and that's going to continue for the foreseeable future. So India, also a G20 country, basically considered a middle-income country, though, unlike the U.S., UK, most of the EU are above middle income, wealthier countries. But India is huge, and India has a lot of resources. So India is able to do things other countries cannot, smaller countries cannot. And I used to do work with the Reserve Bank of India when I worked for World Council of Credit Unions, involving their cooperative banking. And so I know more about India than some places. And so essentially they reduced their reserve repo rate, their main emergency rate, first to 4%, and then they upped it 375 basis points. They have the federal government, the Indian government of India, as opposed to state governments, has had a very large state aid package of at least 0.1% of GDP. And the state governments are contributing as well. They're, like many other federations, the state governments in India are very powerful. And I think it's another 0.2% of GDP equivalent in aid is coming out of state governments. Now, how exactly that aid is put together, a lot of it is in-kind aid. Some of it is cash. And in any event, I personally think cash is going to be more useful, but a lot of state aid is provided in kind programs that are not necessarily the most efficient way to give aid, but that's how their system is set up, and so a lot of it's going through that. They have the Reserve Bank of India has a liquidity program, long-term security repurchases, and other things. There's basically a moratorium on loan payments for 3 months. They've had similar guidance under IFRS 9 as the other regulators we mentioned. They've also, the banks have to file what's called asset resolution plans. Basically, they have 30 days to, from when a loan is bad to, if it's a major large item, to do a stressed asset resolution plan, and then they have to implement that within 180 days. So essentially, they push that off at least to end of June, and 30 days from May 31st. And that may be extended further. They've also, their cash credit working overdraft capital is a type of, essentially retail credit, and the rules on that are eased at least until the end of May. The Reserve Bank of India is interested in large credit exposures, and they put a restriction on bank dividends for the financial year ending May 31st, 2020. And so we'll see how that develops, but India, huge economy, fair amount of resources, they're able to do this stuff. Now, the sampling of other countries, based in large part on who's on here and on this webinar. So Bangladesh is right next door to India, but it's a smaller economy. The World Bank has been providing some aid, but the government resources are more limited. So there's a moratorium on loan payments until the end of June, and a delay of non-performing loan classifications, just like in the international organizations have said. And while India and the other countries I talked about are members of the Basel Committee and the Financial Stability Board, a country like Bangladesh is not. They're part of another Basel Committee group for non-members. But the same international standards apply. So they've been providing liquidity to banks, buying essentially government bonds. They've reduced interest rates, basically, and said that banks' reserves can be reduced, like reserves held by the Bangladesh Bank. And they have several refinancing schemes, particularly for exporters in the agricultural sector, so that credit can be provided there. There's also been a stimulus package, particularly aimed at the export industry, been hit hard, and other measures as well, particularly in trade finance. So Bangladesh is an exporting country, and you see that's where it's going. So with Nepal, another smaller country next to India, so the Central Bank of Nepal, Nepal Rashtra Bank, basically lowered reserve ratio requirements for banks, use up cash, rates on loans from their liquidity facility, released banks' requirement to build up their countercyclical capital buffers. And that's actually similar to the United States. The U.S. had not phased in the countercyclical capital buffer yet. Now that's as well. So that's consistent with the international standards. Reporting requirements are somewhat relaxed, and there's been a loan fund created to provide loans to small enterprises and other specific industry sectors that is basically being funded with central bank money. Now, Nigeria, very large economy in Africa, basically very exposed to oil, and this would be true for any country that's exposed to oil, whether it's Nigeria or a Middle Eastern country, or United States to some degree. United States, Saudi Arabia are the three largest oil producers right now. So that is the fall in oil prices have really hurt their economy, and they probably will have to cut non-essential government spending because of that, which could have worse effects, but they're limited in their revenue. You know, the United States and the other larger countries can essentially borrow at low prices by selling bonds into the market or selling bonds to their central bank, their Federal Reserve banks. That's quantitative easing, essentially. And generate money that way. A country like Nigeria is less able to do that. But they have had a large fiscal stimulus package of over $1 billion US, so that's huge. You know, at least similar to what the United States is doing. They basically also reduced interest rates on several of the central bank's intervention facility funds. So these are for lending to specific sectors, oil. There's several different funds. And so they basically lowered the interest rates and had a moratorium on payments to those for a year. So giving borrowers some breathing room, a lot of liquidity, and then, you know, regulatory forbearance for restructured loans as well. And then for a really small economy, Gambia, the cooperative financial institution credit unions in Gambia were at one point a member of World Council of Credit Unions, work with them. So very small country, not very hard hit by COVID-19 at this point, but they've been receiving some assistance from the World Bank, and they've also have a stimulus package, frozen prices on some products, extended some tax deadlines and tax payments, reduced interest rates, but not a lot of other actions yet. They're not do not have very many cases of COVID-19 at this point, and you know, in terms of what they're able to do, they're probably have the most limited resources of all the talked about here on donor support. And so I can't cover every country in the world, unfortunately, but hopefully this has been a fairly good overview of what countries are doing. So the key takeaway here are the national level supervisors are the ones that have to implement these measures. The international standards are out there. The international standard setting bodies have said what needs to be done or can be done, but you know, your supervisor has to issue guidance or a rule saying that you can do it. If it hasn't happened already, I would lobby them. I would say, well, why don't you do this? And point to the Basel Committee and Financial Stability Board. We're probably in a recession worldwide. That is going to be, we don't know how long or deep it will be, but just simply shutting down the economy for a couple of months, it will, you know, drive everything into recession. And so this will probably be a long road. The market volatility will likely continue, and the trading book risk is there. You can move those assets to your banking book and reduce the volatility there. But if you want to sell things, they'd have to be in the trading book. And you may have accounting issues with that. The capital levels, you know, there are all these risks out there. I'd say right now, liquidity risk is number one, then credit risk, because maybe people can't pay, the market risk, the trading book in particular, and then cybersecurity is a big issue. We're going to do another webinar later about the cybersecurity issues here, but that's a big one right now, especially with remote work. So every bank is now exposed to the security of each of its employees' home Wi-Fi networks, essentially. That's no fun if you're trying to avoid fraud. Now, the accounting issues, though, at least for the short to medium term, we've got the state aid and the IFRS 9 guidance saying, you know, essentially don't recognize the losses. And but the long-term issue is, will the fact that people are not paying lead to a feedback loop? Essentially, things get bad because they're bad, and then they get worse because they've been bad, and, you know, creating a domino effect. We'll have to see. It may be that there's herd immunity achieved more quickly from COVID-19 than believed. It may be ages that people may have had it and not even realized it. The Swedes, in Sweden, they have not had a national lockdown. They say that their COVID-19 cases in Stockholm are already plateauing, so they may reach herd immunity soon. If that's true, then maybe it will not be that big a crisis in the end. But anyway, so that's my presentation, and I guess we will go to questions.
Michael, if you stop sharing slide, we can move
Sure.
to the Q&A. We have received lots of questions here,
Okay.
and what I will do is I will bring to the Q&A. Thank you for joining, and if you have any question, please send it on Q&A, and we'll try to cover as many questions as we can. Thank you for a wonderful presentation, Michael, to laying out the global perspective on how different governments are responding, and there are lots of lessons learned from each other, including Sweden, where they totally went against the norm and trying a different thing with herd immunity. So there are some questions. I'll bring it to your notice, and one is I think I'm not going to ask you a question, but I'm just going to bring it in conversation. Is financial sector is definitely one of the sectors that's impacted as high as, if not equally, as tourism and hotels, hospitality business. It is hit very badly, and we can feel that in US, and I think it's a worldwide story.
Oh, yes.
Yeah, so I'm not sure if you want to add something to that, Michael.
Well, that's a very good point. So in economies that are focused on tourism, this is that, I mentioned oil, but tourism would be another major issue. And there's some countries that have focused on middle-class tourism, but there's others that have focused on higher-end tourism, which is less likely to have a downturn than middle-class tourism. And if there's a recession in Europe, the United States, or Canada, or whatever, middle-class tourism by wealthy people, but no one's doing it now. So all of the tourism-dependent economies and regional economies, tourism-dependent are restaurant industry, all of those things. So each country, a country like Cabo Verde, mostly tourism essentially, and I can't imagine what.
And I'm just going to combine a few questions here about liquidity. So it looks like banks are going to face a pretty high liquidity problems as we tackle this COVID-19. So is there any advice, any recommendation, or anything in your observation how it's been done in the past, or it's going towards?
Well, I think that the regulators and central bankers are trying to stay ahead of the curve here. As when we had the global financial crisis in 2009, 2010, that was really a liquidity crisis. I mean, it was a credit crisis that then caused a liquidity crisis because no one wanted to lend to each other. So it's really the lender of last resort. The central banks and different government funds are trying to pump as much money into the economy as possible. If you do not have access to that, you might be in trouble. The Basel standards, you're supposed to have high quality liquid assets like government bonds that you can sell in these times. Those would probably hold their value. And like I said, the asset-backed securities have mostly been paying, so hopefully reasonable price for that. But being able to get a loan and use those as collateral might be a better approach. But I'd imagine many lenders want to have things over collateralized. You have to be careful. If you have a default event, you could really lose it if you have to triple over collateralize your line of credit default event.
So Michael, there's another question I think you had slightly covered about the mortgage. What's the time period? Like, I know the US has pretty much addressed mortgage very carefully this time. So what's the time period allowed to extend mortgage in standard in the BIS or rescheduling?
Yes.
Can we extend it for the longer period, not just a couple months?
Yeah, well, the United States, they're doing 180 days, so 6 months. And that could potentially be expanded. But essentially, you have the choice to give the borrower forbearance, which is essentially we're going to suspend payments for a period and then the payments will be due again. But many of the lenders are actually doing loan modifications, and there's been the green light given for that, where essentially you extend the term of the loan. So you may or may not continue to have interest accrue, but for whatever period, you could extend it out years. So if you do a loan modification and the regulator is not going to treat that as a forbearance or trouble debt restructuring, you could potentially do a very long-term modification. I mean, in the United States, you can have a 30 or 40-year like mortgage. So yeah, that would be one approach.
So there's another one, like I'm going to combine a few questions on liquidity risk. One is about relaxing KYC or AML, how that's going to be causing for bringing more trouble in liquidity risk for the banking. And also, I know that we're going to be talking about AML in our next session in a couple of days. And then the other one is mostly focused on, the question is on the poor economy, but I think it applies to everyone, that where the private sector is to fund government crisis management expenditures, that's going to cause more, it's going to cause more threat to the liquidity risk going forward for the banking.
Well, with the anti-money laundering thing, we're doing a session on that, like you mentioned. There's a potential for the abuse of the financial system, but being able to onboard clients remotely is really the key for that, I think. So I'm not sure if that answers the question about liquidity with it. What was the second question?
So on the liquidity, the other part was on the private sector helping the government, right?
Oh, yeah.
That's going to cause.
Oh, yes. Well, in situations where the government is having to look to the private sector for funding, that definitely could drive liquidity. It's really the solution that at least the larger economies that can afford to do it is going the other way. I mean, it's just essentially pumping money out because no one is getting money from other sources, really. And, that's what the U.S. Paycheck Protection Program and the EU similar PPE, or I think it was on their slide earlier, funding scheme, the Pandemic Emergency Purchase Program, PEP, PEP, it is. So yeah, the government is looking to the private sector for money right now. I would say that would definitely on the other way.
So the other one is like, this question is specific to Nepal, but I think it applies to any small economy. So do they act, how should they be acting, or what kind of cushion they should be building in this scenario of possible economic slowdown?
Well, I think that, the cushions were intended to be built in advance for this, so like capital and liquidity. Now the crisis has hit. It's like a stress test scenario. I had that on the first slide, but it's real. In fact, I'm not even sure if this is a stress test scenario anybody would have thought was reasonable. If one of my clients had a regulator that wanted a stress test scenario like this, would just assume that, the economy stops suddenly, I would have said, gee, that's why don't we do more realistic? Essentially, not dividending out money would probably be a good thing. Basically, if there are things that you can not pay and not have it be a default event, that would be good. But, like the issue with asset-backed securities, you're being required to make payments to the investors, even though you're not getting payments from borrowers to fund that. From an institutional perspective, it would be good not to pay that stuff. But, especially if you're a smaller player, you don't have very much leverage with really big money center banks. And, they often are the ones who make the rules.
So I think it's as a follow-up came up on this is about in this distress situation, what will be the tolerable distress situation, so like they gave an example of Nepal is about 1.72 NPA level. Now it's they're estimating is to go to 6 to 7%.
Yeah, well, it's the regulators can forbear on enforcing their standards, and I think that if this goes on that much and things really get worse and the capital levels start, that's going to be the next move essentially, because this is like an external black swan type event, unlikely thing, and I think that I would be talking with the regulator now about what are their plans for if things get worse, because really they're the ones who hold all the cards, so to speak. And at least the international standard setting bodies are giving them the green light to potentially forbear on enforcing standards to some degree. And I think that that's ultimately the solution. Because if you think about a bank, it's mostly accounting. It's you have offices and everything, but it's mostly data, and the data is based on, well, an estimation of the economic value of different assets. But there's been a lot of times historically where in banking crises the regulators have changed the accounting rules, and you're already seeing that here. Now, sometimes it's turned out very badly. That's always something you can do, even when the government runs out of cash.
So Michael, like I also had a curiosity just to get your opinion, and I think that also came up directly, indirectly as a question, that is it going to be a repeat of 2008 in terms of like, are we going to end up bailing all these banks, number one. And number two, there's a question on Great Depression. And do you think like we are heading towards that?
Well, I'm hoping that it's not a depression. We're going to see how long this goes on. And if it keeps going on, until they find a vaccine, I think that's the real question. So we don't know. It could very well end up being a depression. Hopefully not. I think that the regulators, compared to the last financial crisis, I think the regulators and the central banks are much better prepared, and they've gotten ahead of this early. There's a tendency to fight the last war, and the last war was a credit/liquidity crisis, credit crisis that caused a liquidity crisis. Now we have a liquidity crisis that may be causing a credit crisis, but it's similar enough to the last war that I think they're going to do an okay job. I think that's what it comes down to. At least the actions so far have been pretty good. So
Michael, we're getting lots of questions, but we'll take just one last question at this point.
Okay.
So the question is like, lots of sectors are going to hit. Almost every sector is getting hit right now. So in your opinion, which sector you think is going to be taking the most hit, and which is going to be the slowest or lowest hit? And also from the recovery perspective, so which one is most likely to recover faster, and which one is the slower?
Okay, well, I mentioned oil before, and I would stick with oil in terms of having the biggest problems for a variety of reasons. First of all, the amount of demand is way down, so the oil prices are way down, and oil is still being produced and it's being stored, so you're going to have a supply glut. And then you have a lot of oil companies out there, but a lot of them were highly leveraged. So you could potentially see bankruptcies there, and then some large banks that have big revolving credit facilities with these oil companies could really get hurt. And oil is also my pick because you have a bunch of economies where they're so dependent on oil that their currency prices fluctuate with oil prices. I mean, even a country like Mexico, oil goes down, the peso goes down. I mean, that's, so I think that has the biggest impact on whole countries. So in terms of ones that are not that effective, you know, the healthcare industry has got a lot of business now, but they're not being able to necessarily do the types of procedures that normally make them money. But if it's a government, you know, finance system, they have a lot of stuff going on. There's a priority. There's a lot of money going to it. I would say healthcare is probably at least. I think with things like tourism, they're going to be pretty badly affected. But things like the restaurant industry, there may be certain things where there's a lot of pent up demand, and that when the lockdown orders end and things like that, people really want to go out and spend money. So I guess in terms of things that'll bounce back, you know, if easy credit is available to buy things like automobiles and heavy equipment and things like that, I think that those may be taken up. And I think areas where there's easy credit are going to be the areas where they bounce back quickly. They're like, you know, you can take out a loan and not make payments for a few years. If you're selling something that can be bought with that loan, you know, you probably will have the sales that didn't happen during the lockdown all pulled forward into the future and happen all at once.
So Michael, thank you for your very insightful presentation. And, you know, I kind of agree, because we all are suffering with it. And we have seen how the healthcare industry is picking up. And that's the reason why we are organizing one on the health sector coming up on public-private partnership, you know, because that's going to be really, really big. Right now, we're seeing an example of even getting a mask or gloves or even the small testing stuff everywhere. The public-private partnership, we have not seen this kind of partnership in healthcare for a long time, you know. And so we're going to have a session on it. And I know that we keep getting questions. Looking at the time, I think I'll have to say, right now, I have to say, you know, we're going to stop taking the questions. And just to let you know, all the participants, thank you very much for your time. You'll be getting an evaluation after this, maybe in next an hour or so. So please send your honest opinion so we can make it better. And you'll be seeing Michael next week again on Monday and Thursday. We have on AML and cybersecurity. And we're also going to be doing following week on cybersecurity from technology perspective, from fintech perspective. So we'll have a couple other presenters from Capital One and Fannie Mae and other financial institutions. There'll be a panel on that. And you'll be getting those notices. Sign up, ask your colleagues, ask your you know, friends who are interested in those topics. And if there any topic that you are interested in, please respond in your evaluation so we can bring that to you. And all I have to say, stay safe and have patience. Things are going to get better. Look at the sky. Sky is much cleaner. It's less polluted. You know, there's something good to think about at this point. Thank you very much. And we'll be seeing you soon on Monday.
Thank you.